stock market and Aussie dollar reaction to the decision by the RBA to cut rates. Look, was it that pronounced?
There wasn't a huge reaction, and there was actually quite a strange reaction in terms of the Aussie dollar. But if we have a look at the market reaction in terms of that RBA rate decision at 2:30, you can see that the decision was around here, and really the impact, the Aussie market moved down before moving higher afterwards. We have a look at the Aussie dollar. Usually when you see a rate cut or expectations of rate cuts, you usually see the Aussie dollar moving lower because of the lower yield. But in this particular instance, we actually saw the Aussie dollar moving upwards after that rates decision, and that's really the market signalling that the rate cycle is perhaps coming to an end. We've seen 7 cuts now since November 2011, where interest rates have moved from 4 3/4% down to 2.5%. And of course, in that time, it's been all about that yield trade. So today, not a huge impact in terms of the market, and a bit of a strange impact in terms of the Aussie dollar. And I think markets just really signalling there that the rate cut cycle is almost over. If we have a look at the chart for this, this is a cash rate over the last 20 or so years from 1993, and you can see that we're in a rate cutting cycle, but of course with interest rates now at a record low, the market really speculating that we only have 1 or 2 more to go.
With a falling cash rate, I suppose a lot of that depends on whether or not you think they've reached the bottom of their easing cycle. But you'd think it would be good for markets as people look for greater return. But is that offset to some degree, do you think, by a lack of confidence, or do you think we are going to start seeing that search for greater return?
Well, James, logically, falling interest rates is good news for the market because it's cheaper for companies to borrow money and to fund their growth. And also, if you have a look at stock valuations, it becomes easier and better in terms of the stock valuation side because the risk-free rate goes down. But actually, if you have a look at all the studies that have been done in terms of the direction of interest rate and the directions of market over time, the direction has a high correlation. So falling interest rates usually correspond with a falling market, and rising interest rates correspond with a rising market. So despite the expectation that falling interest rates is actually good news in terms of earnings and in terms of growth, if you have a look at the direction of interest rates and how the market's reacted over time, it looks like there is a high correlation in terms of the direction of that movement. So it is a bit of a strange one. Having said that, we have seen interest rates falling now since November 2011, and it's been very much about the yield trade. And with the interest rate cycle probably near the end of the easing bias, what we probably will see is some investors thinking about shifting their money out of the income side of things and the yield side of things to more of a growth strategy. We have a look from November 2011. Of course, the financial sector has been one of the best performing areas. It's been up around about 40% in that time. And if we have a look at the stocks which make up that financial sector, there's only been 2 stocks that have managed decreases. That's Challenger Financial Group, which is down by 6%, and also FKP Property, which is down by about 44%. But all the other stocks seeing increases. The best have been stocks like Magellan Financial Group, which is up by more than 700%, and Flexi Group, which is up by more than 100%. But of course, the big 4 banks have also been doing extremely well in that time, with stocks like Commonwealth Bank reaching record highs. So I guess the next move for investors and the next things to think about is whether we are coming to the end of this interest rate easing cycle and really how that's going to impact on asset allocation in their portfolios.
People might look to get exposure as we see a lower cash rate, and there's a lot of talk about trying to get in on the growth stocks, the cyclicals that should benefit. Do you see that happening? I know you spoke about the search for yield, but at some point, are we going to see in the near term people getting a little bit more upbeat on some of those cyclicals? I mean, look at the iron ore price in Aussie dollar terms, like $145 a tonne, but people are still negative over it.
I think we are seeing the market getting a lot more positive on the cyclical sectors, excluding the miners. While the iron ore price is holding up fairly well, they still remain quite nervous around what's happening in terms of China and the slowing growth rates that we are seeing there. So just a period of transition for that mining space and the mining services space. But most areas of the market are cyclical, and these lower interest rates are designed to help stimulate those cyclical areas. So Stephen mentioned a couple, the retail and the construction side are the 2 big ones. And if we have a look at the consumer discretionary sector, which is cyclical, this has been the best performing sector in 2013. This area is up by 27%, so beating the bank's performance of 21%. So We know that the market looks forward, and as we do come to the end of this easing bias by the RBA, investors and traders are going to start to think, well, how am I going to position my portfolio for the next phase of the market where interest rates are potentially increasing and earnings are also increasing, and that's usually the cyclical areas of the market, and of course these areas run before the actual event happens. So looking forward, we have seen the consumer discretionary sector already probably reacting to a turning in the cycle. We know it's been very difficult for those cyclical areas, but stocks like JB Hi-Fi up more than 100% over the past year.
Yeah, indeed. And look, Julia, there were some report cards out today. I want to get your thoughts on those. Firstly, Downer EDI, your thoughts?
I think with these earnings report, the key is to look at the outlook statements. Now, Downer EDI by the end of the session was down by 0.5%, but its actual result was actually quite good. We saw dividends coming back into the picture, so an 11-cent final dividend compared to the previous year where we saw a 0-cent final dividend, no final dividend. And of course, we have a look at the forecast. They had been forecasting underlying EBIT to come in at $370 million. It came in at $370.3 million, so pretty much on expectations. An underlying net profit at $210 million. It actually came in at just over $215 million, so up by 10% there. If we have a look at what's happening in terms of Downer EDI, we are getting some more positive news in terms of the Waratah contract. We're also seeing some pretty solid mining contracts here, which are helping to underpin the results, and New Zealand is really starting to ramp up. But the outlook, Downer EDI coming out to say that it doesn't expect profit to increase in the current financial year. So the outlook's still quite murky, and I think that's what drove the shares down today. The shares only off by 0.5%, but really on the back of a quite solid result.
And look, also Cochlear coming out with their report card today. But the markets seem to, I suppose, welcome it. It was up about 1.5% today.
Once again, this is about the outlook. The recall, which was in the past, was a negative for Cochlear, and that resulted in sales being impacted. The US sales were down by 4%. We also saw Europe, Middle East and Africa down by 1%. But looking forward, it's all about Nucleus 6. The processor here is 5 times faster than the latest implant that they have. And so looking forward, things are looking quite good for Cochlear. One of the things to watch out for is the hedging contracts here. The hedging gains were a little bit less than the previous year, and they're going to continue to roll off in the current financial year. So that's going to start having a smaller impact. But on the flip side, the innovation will start to come through from Cochlear, and the Nucleus 6 implant is really going to help with that. So the stock actually up by 1.4%, and this is a stock that you buy because you believe in the new implant and the sales that that's going to drive.
$60 it closed at today. Do you see, is it an expensive stock? I mean, we saw it come off a lot when we saw that recall. It's sort of steadily made its way back to a level above that, but still off its highs. Do you see further upside in this stock?
I think if you have a look at Cochlear, a lot of the premium has gone out of this stock because it was seen as a gold premium in this hearing implant
And people
area.
just loved it. People just love what they do. A good Australian success story as well.
It's a fantastic Australian success story. And if we have a look at this stock, the last couple of years have been absolutely horrid for it. I think now for investors, though, it's time to start thinking about the next couple of years, and this is really going to be driven by this new device, which is a much superior device, and this is where the strength and the innovation coming through from Cochlear will really start to shine. So while the last couple of years have been quite painful because of the recall that we have seen of the Nucleus devices, I think the next couple of years you're really going to start to see the impact of the innovation and the new product come through for Cochlear.
Fantastic, Julia. Look, really appreciate